Hello, fellow investors and soon-to-be investors. Welcome to the exciting world of smart investing. If you're looking to take control of your finances and make your dreams a reality, you've come to the right place. In today's world, where markets and economies are constantly changing, the key to financial success is all about making smart choices, being flexible, and staying focused on your goals. Join us as we dive into the exciting world of building wealth. We'll be exploring the art and science behind it, taking it one step at a time and one principle at a time. We've got you covered when it comes to setting clear goals for your financial future and helping you navigate the ins and outs of risk, diversification, and research. Let's talk about learning the art of budgeting, the magic of compounding returns, and why it's important to stay grounded in logic instead of letting our emotions take over. But wait, there's more. We'll also dive into the details of managing costs and maximizing tax efficiency. This way, every dollar you invest will be working hard to help you achieve financial freedom. We'll also make sure you stay updated on the latest economic trends and market dynamics so you can make the best decisions for your own financial journey. Hey, if you're all set to take charge of your financial future, go ahead and share, and subscribe to our channel right now. Why not join our community of savvy investors? We can all embark on this exciting journey toward financial success together. It's going to be a great ride. Hey, just a friendly reminder that if you invest wisely today, you'll be setting yourself up for a bright future. Here are 10 principles you should consider before investing. Let's start by setting clear goals together. Establishing clear investment goals is an essential first step in creating a successful and meaningful financial strategy. It's commonly said that a goal without a plan is just a wish, Antoine de Saint-Exupéry, which reminds us how important it is to transform our dreams into achievable goals. Having clear goals is really important when it comes to making smart investment choices. It helps you make informed and strategic decisions. By setting clear goals, like saving for retirement, buying a home, or funding your child's education, you give your investment strategy a sense of purpose. Each goal you have may have a different time horizon and risk tolerance associated with it, and having this clarity will help you customize your portfolio accordingly. One of the most powerful messages regarding setting clear goals in the financial realm comes from Zig Ziglar, a renowned motivational speaker and self-help guru. He said, "A goal properly set is halfway reached." Ziglar's statement underscores the paramount importance of not just having goals, but clearly defining and understanding them. In the context of finance, this means being precise about your financial aspirations, whether it's achieving a certain net worth, buying a home, or retiring by a specific age. Setting clear, actionable objectives can pave the way to achieving them. So it's crucial to invest in your own knowledge and understanding of your financial goals. This will be the initial step towards reaching them. Setting clear goals is really important because it helps you stay motivated and focused. Plus, it makes it easier for you to track your progress and see how far you've come. It helps you keep track of your progress toward your goals and make any necessary changes as you go. Setting clear investment goals is a great way to turn your dreams into a solid plan for your financial future. It helps you make smart investment choices and ensures that your efforts are focused and successful. The second is to determine your risk tolerance. Evaluating your risk tolerance is really important when it comes to investing. It helps you figure out how much risk you're okay within your portfolio. Investment guru Peter Lynch once wisely said, "It's important to know what you own and why you own it." To do this, it's helpful to carefully consider your financial situation, goals, and personal temperament. Understanding how much volatility and potential loss you can handle is key. Risk tolerance is something that differs from person to person and is unique to each individual. Some investors might be open to taking on more risk in hopes of achieving higher returns, while others might prefer a more cautious approach to protect their capital. It's really important to understand that your risk tolerance can change as your financial situation and life circumstances evolve. The main aim is to find a good balance between risk and reward that suits your specific situation and goals. This balance will help you make investment choices that will give you peace of mind, even when the market gets a little bumpy. By taking an honest look at your risk tolerance and making adjustments to your investment strategy, you can feel more confident in your financial decisions and improve your chances of reaching your long-term goals. The third is diversifying your portfolio. Diversifying your investment portfolio is a fundamental principle that can greatly increase your chances of achieving long-term financial success. It's always a good idea to diversify your investments by spreading them across different asset classes and sectors. This way, you won't have all your eggs in one basket, as the saying goes. Investment guru John Templeton had some great advice when he said, "It's always a good idea to diversify your investments. By spreading your money across different stocks and bonds, you can increase your safety and minimize risks." Diversification is rooted in the concept of risk reduction. By spreading out your investments across various asset classes like stocks, bonds, real estate, and even alternative investments, you can reduce the impact of any one investment's poor performance on your overall portfolio. When one asset class doesn't do so well, don't worry. Other asset classes might step up and perform better, which can help reduce any losses. This strategy also helps you find a good balance between risk and potential returns, making sure your portfolio matches your comfort level and investment objectives. Furthermore, diversification is a great way to enhance stability and resilience in your portfolio, especially when faced with unpredictable market conditions. It's great to keep in mind that diversification doesn't completely eliminate risk, but it does help spread and manage it more effectively. It's a great idea to regularly review and rebalance your diversified portfolio. This will help you keep your asset allocation on track and make the most of its potential for long-term growth, all while minimizing any unnecessary risk. Let's move on to the next principle, which is doing your research on investments. It's always a great idea to do thorough research before making any investment decisions. It's a smart and responsible practice to ensure you're making informed choices. You know what they say, knowledge is power, and it definitely rings true in this situation. Before you invest your hard-earned money, it's important to thoroughly understand the assets or securities you're interested in. As Sir Francis Bacon wisely said, knowledge is power. To conduct effective research, it's important to study the historical performance of the investment, analyze the risks involved, and estimate its potential returns. Understanding the performance history is really helpful in assessing how well the investment has done in various market conditions and if it matches up with your financial goals. Taking the time to consider the risks involved can help you determine if the potential rewards are worth it. Just like Warren Buffett wisely said, risk comes from not knowing what you're doing. Moreover, conducting research allows you to make well-informed decisions that rely on facts instead of emotions or rumors. It's great because it helps you build a solid investment strategy that matches your goals and risk tolerance. By taking the time and effort to thoroughly research your investment options, you can boost your confidence, decrease the chances of making impulsive decisions, and work towards achieving your financial goals with more precision. Let's now move on to the next principle, which is creating a budget. Creating a budget is a really important step in the world of investing in personal finance. As George Foreman wisely said, you must live within your means. This principle also applies to investing, my friend. Before you start your investment journey, it's super important to create a budget that lays out your income, expenses, and savings goals. This will help you stay on track and make the most of your investments. The budget is really important for your financial plan. It helps you make sure you're setting aside some money for investments while still covering your essential expenses and saving for emergencies. Additionally, this budget serves as a way to protect you from investing money that you might not be able to afford to lose. Having an emergency fund is really important. It helps you be prepared for unexpected expenses. It's a good idea to keep your investments separate and focus on long-term commitments. By sticking to a budget, you can invest with peace of mind, knowing that you're not putting your financial stability at risk. Every dollar you set aside for investment is a dollar you've intentionally allocated for this purpose. This practice is great for developing financial discipline and keeping your financial life in balance. It will help you work towards your financial goals with more confidence and security. The next principle reminds us that it's always a good idea to start early. Getting a head start on your investment journey is a great idea. It can make a big difference in your future financial success. The saying, "time is money," holds a lot of truth, especially when it comes to investing. Warren Buffett also emphasizes this point by advising that the stock market is meant to transfer money from active investors to patient ones. Let's explore why starting early is incredibly important. Investing early is a great idea because it gives your money more time to benefit from the amazing power of compounding returns. Compound interest or returns are actually pretty cool. They mean that your earnings can generate even more earnings over time. It's like a little bonus that keeps growing. This compounding effect can lead to exponential growth in your investments as your initial capital and any returns you've earned continue to earn more returns. Over time, even small contributions can add up to create a substantial amount of wealth. Starting early is a great idea. It can also help protect you from any ups and downs in the market. Investing over a longer period of time is great because it helps you navigate through market ups and downs. Short-term market downturns are usually balanced out by long-term upward trends, so you can stay calm and confident. This means that you're more likely to stay calm and not be negatively impacted by temporary market turbulence. Basically, the earlier you start investing, the more likely you are to achieve your financial goals, like saving for retirement, buying a home, or funding other important moments in life. Investing early can be a really smart move. The power of time and compounding returns can work in your favor, helping your money grow over time. The seventh principle is to keep an eye on your investments. Keeping an eye on your investments is really important in the world of finance. It's like following the famous saying, "Trust, but verify." Ronald Reagan. It's really important to regularly review your investment portfolio to make sure it's still aligned with your financial goals and risk tolerance. Here's why this practice is incredibly important. Markets are always changing and can sometimes be hard to predict. Economic conditions can vary over time, and different asset classes may have varying performance. By keeping an eye on your investments, you can stay in the loop about how your portfolio is responding to these changes and if it's still on course to meet your goals. Monitoring is great because it helps you make any necessary adjustments. If your portfolio starts to have too much of one type of investment or industry because of changes in the market, you might want to consider rebalancing it to keep it in line with your desired mix of investments. In addition, it's great to consider taking advantage of opportunities to buy or sell investments based on your long-term strategy, instead of making impulsive decisions based on short-term market events. In addition, it's great to stay engaged with your investments, as it helps you maintain a disciplined approach. Emotions such as fear and greed have a way of influencing our decisions, but it's important to remember that regularly reviewing your portfolio can help you stay on track with your overall strategy. By doing so, you can avoid making impulsive choices solely based on sentiment. Monitoring your investments is super important because it gives you the power to make smart choices, improve how your portfolio is doing, and make sure it matches up with your long-term financial goals and how much risk you're comfortable with. It's a great way to boost your confidence in your investment decisions and increase your chances of reaching your financial goals. The next principle is to avoid emotional decisions. It's always a good idea to take a step back, think things through, and consider all the factors before making any choices. Making rational decisions when it comes to investing is crucial for achieving long-term financial success. Emotions like fear and greed can sometimes lead investors astray, causing them to make quick decisions that go against their well-thought-out investment plans. It's common for fear to arise when the market goes down, causing some investors to sell their assets in a panic. Selling out of fear can sometimes lead to locking in losses, which isn't the best approach for building wealth in the long run. On the other hand, being a little too greedy can sometimes make us act impulsively, like going after trendy stocks or risky investments without fully grasping the potential dangers. To make sure you don't get caught up in these emotional traps, it's really important to stay dedicated to your investment strategy. Benjamin Graham had a great point when he said, "The investor's main challenge, and maybe even their biggest obstacle, is often themselves." It's important to create a strategy that aligns with your financial goals, how much risk you're comfortable with, and a logical evaluation of the market. This strategy will be a reliable guide for you, especially when emotions start to make things uncertain. Additionally, it's important to have discipline and take a long-term perspective in order to avoid making decisions based on emotions. It's important to understand that markets can be unpredictable, and it's normal to experience ups and downs in your investments along the way. Sticking to your strategy is all about staying strong and not giving in to impulsive decisions driven by emotions. Instead, keep your eyes on the prize and focus on your overarching financial goals. You've got this. Basically, following this principle is not just a suggestion, but a crucial requirement for achieving success in the world of investing. It helps you smoothly navigate the ups and downs of the market while keeping a calm mindset, sticking to a disciplined strategy, and staying focused on your long-term financial goals. Let's move now to the ninth principle, which is minimizing costs. Reducing investment costs is a key principle that can greatly affect your overall returns in the long run. This idea goes along with the famous saying, "A penny saved is a penny earned," which is often credited to Benjamin Franklin. Here's why it's important to be mindful of costs in your investment approach. First and foremost, it's important to keep in mind that costs can gradually eat away at your returns over time. Did you know that even small fees like management fees, trading commissions, and taxes can add up over time and affect the growth of your investments? It's something worth considering. It's like a leaky bucket, where every cost is like a little drop of water slipping away from your efforts to build wealth. By opting for low-cost investment options like index funds or exchange-traded funds, ETFs, you can greatly minimize these leakage points. These funds usually have lower expense ratios compared to actively managed funds, which is a win for your wallet. Additionally, it's important to keep taxes in mind as it plays a crucial role in reducing costs. Taxes can have a big impact on your investment gains, so it's important to manage them well to make the most of your after-tax returns. There are some great strategies you can use to make your taxes more manageable and keep more of your hard-earned money. One way is by choosing tax-efficient funds, which can help lower your tax liabilities. Another helpful strategy is tax loss harvesting, which can also help reduce your taxes. By using these strategies, you'll be able to keep more of your investment returns in your pocket. In the long run, even small differences in costs can make a big impact on the value of your portfolio. This highlights how important it is to make choices that are cost-effective. Did you know that John Bogle, the amazing investor who founded Vanguard Group, was a big supporter of low-cost investing? He once said, "In investing, you get what you don't pay for." This means that by keeping your investment costs low, you can make the most out of your efforts to build wealth. This will help your investments work better for your future financial goals. It's great to take a proactive approach. By doing so, you can keep more of your hard-earned money and make sure your investments are set up for long-term growth and financial security. The final principle is to stay informed. Staying informed is super important when it comes to successful investing. You know what they say, knowledge is power. With the finance world always changing, it's crucial to stay updated on economic and market trends, as well as any updates on your investments. Ray Dalio, the founder of Bridgewater Associates, once insightfully noted, "He who works with the door open gets the most light." This wise reflection underscores the value of openness and adaptability, especially when navigating the unpredictable terrains of financial markets. It serves as a reminder of the importance of continual learning and being receptive to new information in the world of finance. Being well-informed is really important for a few key reasons. First, it helps you make informed decisions about your investments. Just wanted to mention that economic data, geopolitical events, and corporate earnings reports can have a big impact on the market. It's super important to understand how these factors can affect your portfolio. It's great because it allows you to easily adapt to any changes in the market. This means you can make smart adjustments to your investments or asset allocation as needed. Additionally, staying informed can be really helpful in effectively managing risk. Being aware of potential risks and uncertainties is really important because it helps you take steps to protect yourself. You can do things like diversifying your portfolio or using hedging techniques to minimize the impact of these risks. It encourages you to take a proactive approach in protecting your investments from any negative market events. Additionally, it's important to have a good understanding of your investments so that you can make decisions that support your long-term financial goals. Recall the wisdom of Benjamin Graham, often referred to as the father of value investing. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Graham's insight underscores the essence of meticulous research and clear understanding in the realm of investing. Rather than making hasty decisions, he encourages investors to thoroughly analyze and comprehend their investments, ensuring that they not only offer potential returns, but also safeguard the capital. This fundamental tenet is invaluable for anyone navigating the complex world of financial markets. This understanding helps you evaluate if your investments still align with your goals and if it's the right time to buy, sell, or hold based on logical analysis instead of emotional decisions. Staying informed is not only a choice, but it's also a responsibility for investors, my friend. It helps you feel confident while navigating the complexities of financial markets, make well-informed choices, and maintain a disciplined, long-term perspective. In the ever-changing world of finance, having knowledge is truly empowering and essential for reaching your financial goals. As we conclude this journey through the essential principles of smart investing, remember that your financial future is in your hands. These principles are not just words, they are the roadmap to securing your dreams, whether it's a comfortable retirement, a new home, or financial peace of mind. We've covered the importance of setting clear goals, assessing your risk tolerance, diversifying your portfolio, and the significance of research, budgeting, and early action. We've emphasized the need to stay vigilant, avoid emotional pitfalls, and minimize costs to optimize your returns. Now it's your turn to take action and put these principles into practice. The journey to financial success may have challenges, but with the right knowledge and mindset, you can navigate them with confidence. If you found this information valuable, don't forget to like, share, and subscribe to our channel. Join our community of forward-thinking investors who are on a mission to secure their financial futures. Let's support each other on this exciting journey towards financial empowerment and freedom. Remember, your financial success begins with informed decisions, and we're here to help you every step of the way. Thank you for joining us, and here's to your prosperous future.